A running market is full of mysteries. To understand Forex trading from the beginning, we should have to dive into subatomic level of the market. Today, we will lay the foundation Forex analysis by learning supply and demand theories that pay behind the market and discuss about a popular secret of the market known as the value area. If you are new to volume analysis, stay focused and you will know. Let's talk about the price. The Forex market is an auction market. Your broker is the intermediary body. It is bound to facilitate transactions between buyers and sellers. The difference between the Forex market and a typical auction is that the Forex market runs electrically, connecting buyers and sellers, while a typical auction does it physically. Here is Sam. He wants to buy 100 USD spending some Japanese yen. First, he needs to signal to his broker, stating the amount and at what price to buy. If he wants to buy at the current price, the broker needs to find a suitable offer at the current price in the Forex market. Luckily, John is willing to sell 100 USD at the same price, hoping to buy some Japanese yen. The broker buys from John 100 USD through the Forex market and sells to Sam. Your order was filled instantly at the current price. The price was not moved. As you need money, the broker too needs at least some to survive. When a transaction happens, the broker will buy from the seller at a slightly lower price called bid and sell to you with a slightly higher price called ask, so the broker can retain a small amount of money called spread. In summary, when Sam wants to buy, he will buy at the asking price where the broker is willing to sell upon his request after finding a suitable seller, which you can see in the chart as the ask line. At the same time, since John wants to sell, he will sell at the bidding price where the broker is hoping to offer that amount to Sam at the ask price. You can see that price as the bid line. Since the broker has bought from John at a lower price and sold to Sam at a higher price, the broker has now earned some from the transaction. It can be identified as the spread. Several months elapsed. John wanted to buy USD in the Forex market. By this time, the US economy has grown significantly, but the USD price against the Japanese yen remains the same. John enters into the Forex market hoping to buy 100 USD, spending the Japanese yen he has bought before for a business purpose. He informs the broker by tapping on the buy button. At the same time, Sam decided to sell some USD to buy some Japanese yen for a trip to Japan. By the way, Sam knows that the current price is lower than he would expect because the US economy is rapidly rising. Anyhow, at this moment, only one option exists in his sight. Instead of selling all 100 USD he had bought a time ago, he decided to sell a portion of it. Here he offers 50 USD to the Forex market. The broker buys the 50 USD offered by Sam in the Forex market to fill John's order. Although the broker knows that John needs another 50 USD, it can do nothing instead of searching for someone else willing to sell another 50 USD. Eventually, another was found. This is Eric. He will offer 50 USD to the market, but at a slightly higher price than the current price spore. The broker has to accept anyhow because John is waiting for his order to be filled. The broker buys from Eric in the Forex market at that price. John is happier now. Instantly, the market prints on that price because there was a trader who sold at that price. Not surprisingly, more traders have popped up in the market while John and Sam walk happily away from the market, bidding to buy USD at the current price, knowing that USD is currently undervalued compared to the growing economy. The broker is now in trouble. Sellers are hesitant to offer a large amount of USD to the market because selling USD later, when the price goes up, gives more Japanese yen than selling them now. Since buy volume exceeds the sell volume, market price should go up, looking for selling volume to match such buying volume. This process is called auction up. When the market price goes high enough, the mentality of traders flips. The majority think that price is too high, and subsequently sell volume comes to the market as new sellers or profit takers. The price will fall. This process is called auction down. This time onward, the buyer's volume is called demand, and the seller's volume is called supply. The auction up and auction down processes continues owing to the mentality extremes of market participants. However, there will be a price where 50% of buyers think that this price is worth buying, and 50% of sellers think that this price is worth selling, where the buying volume equates the selling volume. We called it the price of supply and demand balance. This price is called fair price or fair value, technically where no price movement or minimal price movement happens for a while. It's the agreed price for that particular time period, hence the fair value of that time period. This fair value is valid for a specific time period. We call it value time. This entire value formation process is termed the valuation process or the balancing. You should note that the market spends more time at the fair price than at extremes. It's a very important concept and will be discussed in detail in the next video. Now you can see why identifying the fair value is important. It tends to attract the price toward it, like a magnet. You can see the reason, obviously, because more away from the fair value, market participants think in a biased manner and eventually auction up or down to the fair value by the process we call price correction, where we find our profitable trading opportunities. By the way, did you notice there is a price range surrounding the fair value? It's called the value area. Fair value is bound to be moved to another price level by the majority of participants if they feel the current fair price is undervalued or overvalued. Then the majority will invalidate the current fair value and make the price move to a new value area where a new fair value will be formed according to the thinking pattern of traders. This process is called the value finding process, where several volume time strategies lie. The value finding process and trading opportunities will be discussed in detail later on. If the value finding process is successful, the market will run invalidating old fair values and forming new fair values. This is the process that everyone knows. It's called trending, or if you draw a line, it's called trend. The definition of a trend is formation of new fair values in a specific direction, which shows the mentality of the majority. Trading a trend is a dangerous business plan if you don't know about the real fair value, because market is almost always attracted by the real fair value. That's why it's enormously important to have the ability to identify the real fair value. Let's recap fast. You have learned today about some important concepts of price, which will be needed very much in coming lessons. You have learned that when you execute a trade, the price it's executed depends on whether you are buying or selling. You mastered the principles of auction market theory. You now know how a fair value is formed according to supply and demand. You know somewhat about how a trend is formed, and it's dangerous to trade a trend. In the next video, you will master the basics of market volumes and time.